All right, hello again, everybody. This is Mike with the Netpicks Inner Circle. In this week's options trade of the week, we're actually going to take a look at two different trades. I'm seeing a lot of opportunity just based on what we've seen over the past couple of weeks. There's a couple areas of this market that are really jumping off the screen at me. I'm seeing opportunities in gold. So we're going to take a look at GLD, which is the gold ETF. And I'm going to take a look at XLE, which is the energy ETF. Both areas of the market there have been very, very active. In the case of gold, we've seen a pretty big move to the downside over the past week. In the case of energy, oil's been on an absolute tear on the upside. It's been very, very impressive on the upside over the past couple of weeks. So I think there's opportunity in here for periods of consolidation or even some retracements, and we're going to look to take advantage of that with our trades that we'll talk about here today. We'll also talk through our one open position that we still have on, the trade from last week, and then we'll take a look at a trade that we closed out earlier this week on CMG. This was a trade of the week from a few weeks ago, and we booked a profit on this one here earlier in the week. So let's start out by taking a look at GLD. You're looking at a chart. This is a 195-minute chart of GLD on the screen. So the 195-minute chart just speeds things up a little bit. You know, it just gives us 2 candles a day instead of 1, like you would get if you're using a daily time frame. So I like the fact that we get a little bit more frequency, get a little bit more active looking chart here. I also have some standard deviation channels on the chart, and those are the yellow, the white, and the red lines that you see on the chart. Over the past week or so, and actually you can go back to early April, we've seen a pretty nice move to the downside on gold. Now, when you take a look at gold and energy, we could certainly sit and talk about, why the movement has occurred like it has. A lot of it's due to what's happened in the dollar. A lot of it's due to what's happened in interest rates and in the bond market. It's all tied together. Bottom line is price action is king. Price action is going to tell us everything that we need to know. So we all might have opinions on what we think gold and energy is going to do going forward. The key there is to block that out and focus strictly on price. I'm focused on the near term. I'm focused on what's going to happen over the next couple of weeks. What happens 6 months from now, what happens a year from now, that doesn't matter. We could certainly see gold fall apart over the next 6 months. We could see energy go up to $100 a barrel in the case of the crude oil futures market. Doesn't matter. I'm looking at the next couple of weeks, and I think the odds favor a period of consolidation, or in the case of gold, even a bounce to the upside. And here's why. Just over the past week, notice how we touched this red line on the chart. That's indicating the second standard deviation channel that I have on the chart. When you hit that level, that indicates to me an extreme has been hit. It means we're very oversold. Now, it does not mean we're going to find support there and it's going to immediately move to the upside. We could certainly see this thing kind of bounce around in here, maybe move a little bit lower. However, when you hit a 2 standard deviation move like this, the odds are against that trend continuing to the downside, at least without getting, a bounce to the upside in the near term. So the numbers just back up being a little neutral to slightly bullish here. And that's what we're going to look to position ourselves with our trade of the week. We're going to take a look at selling a put spread here. So it's based solely off of price action being oversold, us hitting that second standard deviation channel on the chart. Again, I'm not looking to time this trade perfectly. Okay, if I get in a day or two early, I'm not concerned with that. That's the nice part about selling spreads. We put the time decay in our favor. So let's go over to the trade page and let's talk through this. We have a number of different expiration cycles that we have available to us. We've got some weekly cycles in here. We've got 3 of them. One with 7 days left, one with 14 days left, and one with 21 days left. And then we can also go out to the June monthlies that have 28 days left. I've been trading a lot of June options here over the past couple of weeks, and there's a couple of reasons for that. The main being the VIX has gone from the high teens, low 20s, all the way down to the 12 or 13 handle. The VIX has been crushed. They've sucked all the volatility out of this market. And when that happens, the prices of the options are going to get cheap. They're going to get inexpensive. And it becomes more difficult with those shorter term options to collect enough premium to give you a good risk to reward ratio. You just can't get a very good profile on the trade. So one way to compensate for that is to go farther out in time. So I've been using the June options. They have 28 days left. By going out farther in time, I'm able to collect a little bit more premium. It also gives me a little bit more time to be right. So again, like we just talked about a few moments ago, if I'm a couple days early here, if gold doesn't bottom, if we kind of move to the downside a little bit more going into next week, I'm not concerned with that. I've got time on my side here. I can afford to hold this trade longer and not get hurt immediately. right? So I'm going to take a look at those June options, and we want to come in and we want to take a look at selling a put spread. I want to position myself with a bullish outlook. Now, I don't want to just come in and buy a call option here on GLD, because if I buy a call option, the timing is crucial on that trade. The moment I buy that call option, the time decay is working against me. So I'm going to lose money if that trade doesn't move in my favor immediately. So instead of just buying a call, I still want to be bullish, but I want a little bit more of a neutral kicker there, just in case I'm not right directionally right off the bat. So selling a put spread is still a bullish trade. We're just going to give ourselves more ways of making money. So what I was looking at here today is selling the 122-121 put spread. Again, this is the June 15th cycle, so we've got 28 days left. So I'm selling the 122 put. I'm buying the 121 put to make it a risk-defined trade, and I can collect 35 cents mid-price on this trade. If I collect 35 cents, I'm collecting $35 per spread. That's the most I can make on the trade. The beauty on this thing is I'm only tying up $65 of capital. I love trading spreads like this because they're really open to anybody regardless of account size. All you need is $65 and you can put this trade on. If you've got a bigger account size, you can put this thing on 10 times, 20, 30 times. You put it on 10 times and you still only have $650 of risk. So it's a very manageable type of a trade. It gives you a lot of flexibility as far as position sizing goes. Now, the $65 is my maximum loss scenario if it goes completely against me. So it is a risk-defined trade. I like that feature because, again, in this type of an environment with so much headline risk, so much global risk, I don't want to take undefined risk at this point. I want to define my risk. I sleep better at night knowing that worst-case scenario, I lose $65, right? Now, I'm risking, right around 2 to make 1, or not to the penny, but very close to that range. Why would I be willing to risk 2 to make 1? In this case, it's because I have so many ways of making money on the trade. My break-even point is at 121.65. That's calculated by taking my short put strike, the 122 put that I'm selling. I'm subtracting the 35 cents that I'm collecting to put the trade on. That gives me that break-even. So as long as GLD finishes above that level, I don't care if it moves up, down, or sideways. As long as it stays above 121.65, I get to make money on the trade. Even if it stays above that number by 2 cents. Doesn't matter. I don't need a big move. I can make money in all three types of market scenarios as long as price stays above that level. Okay, I also make money from time decay adding up and from volatility decreasing. So I've got 5 different ways of making money on the trade. That's why I can justify risking 2 to make 1 on this type of a trade. Okay, so again, bullish outlook gives me a little bit more of a neutral kicker, or it can continue to move to the downside slightly. It's certainly leaning bullish here. So, the bigger move to the upside, the faster the move to the upside, that'll work for us. We just have a few different outs just in case we're wrong on the timing of the trade or if we're wrong on the directional move right off the bat. So really nice trade here. I love the odds. And again, with so much time left to expiration, we can afford to be patient on this thing just in case it doesn't move immediately in our favor. So that is the first trade on GLD. The other one that I'm going to take a look at, let's go back over to the chart here, and let's switch this from GLD to XLE. It's a very similar chart pattern, just in reverse here, because now we're overbought. And look at where price action got to yesterday. Okay, we got up and we were approaching that second standard deviation channel on the chart. It's been a phenomenal move going back into the 1st of April. Basically a straight move to the upside with very little pause in here. So we're overbought in the near term, just like I mentioned on gold. I'm not saying the top is in on oil. We could certainly see oil go up to $100. And when I say $100, I'm talking about the futures market. Right now, we're currently sitting around 71.50 on the futures. So we could certainly see a further move to the upside. I don't care what happens a couple months from now. I'm concerned in the near term with this overbought condition. So I'm going to take a look at selling a call spread here. So just like we're doing in gold, we're taking advantage of an overbought extreme. I'm expecting a period of consolidation, or in this case, a pullback, and I'm going to take advantage of that outlook by selling a call spread. So let's go over to the trade page, and let's switch this over from GLD to XLE. So in this case, I'm going to take a look at selling the calls, and I'm going to turn it into a spread. Again, I like the defined risk nature of selling a spread. I don't want to take undefined risk in this type of a market that we've seen over the past few months. So let's go ahead and take a quick peek Everything that we talked about over on GLD is very similar on XLE, meaning I'm going to trade the June options. The volatility has been crushed in this market. I just think going farther out in time, we can collect more premium, gives me a better risk to reward scenario, and it gives me more time to be right, just in case this market isn't ready to turn. Just in case we kind of drift to the upside a little bit further here, I'm still okay. I can still survive because I've got 28 days left. So what I'm looking at is selling the 79.80 call spread out in the June 15th options, again, with 28 days left. So I'm selling the 79 call, I'm buying the 80 call to make it a risk-defined trade, and this one is currently trading for 37 cents mid-price. So if I collect 37 cents here, okay, I'm collecting 37 cents per spread. That's the most I can make on the trade, regardless of what happens here going forward on XLE. If we get a big collapse in energy, the most I can make is that $37 per spread. I'm risking $63 per spread. It's the most I can lose on the trade. So if I'm dead wrong and oil just continues to go to the moon here, the most I lose on this trade is $63. So it's a very manageable trade here, again, with any type of account size. If you're working with a very small account, this is a very manageable trade. You're talking about less than $70 of risk. If you've got a bigger account, it's not uncommon for me to put a position on XLE with 30, 40, 50 contracts. It's pretty liquid. You can get filled with no issue there. Now, my risk reward, I'm risking $63 to make 37. The reason I'm willing to risk more to make less is because I have so many ways of making money on the trade. We have 5 ways of making money, just like the GLD position. My break even's at 79.37. That is calculated by taking my short 79 call. I'm adding on the 37 cents. It gives me my break even at 79.37. As long as XLE stays below that number, I make money. So if it moves up, down, or sideways, as long as it stays below 79.37, I'm okay. I can make money. Now, ideally, if it moves to the downside quickly, let's just say going into next week, we get a nice 3-4% pullback in oil. I wouldn't be surprised to see it at all. That's great. I can make money very quickly from that. If it doesn't happen, if we just kind of consolidate sideways, that's the beauty of selling a call spread, because I can make money from the sideways movement as well. I also make money from the time decay adding up and from volatility decreasing. So we have 5 ways of making money on the trade. Now, how do I manage these positions? What am I looking for here? Whatever I collect for both of these spreads, that's the most I can make on the trade. But the problem there is the only way I get to collect and keep the entire premium is if I hold the expiration. I'm not willing to do that in most cases, just given how active the markets have been. My initial target zone is 50 to 75% of whatever I collect to put the trade on. So in this case, if I collect 37 cents, my initial target zone is 50 to 75% of that number. So if I can buy this thing back for between 9 and 18 cents, that's going to be my initial target zone. I like to close trades out early because then I don't have to mess with expiration week. The closer you get to expiration, the time decay picks up, which is a good thing. The gamma risk also increases, meaning those options are going to react faster to changes in stock price. So the last week to 10 days before expiration, those options are going to get very, very active. And you can go from a nice winning trade to a losing trade immediately in expiration week. And I don't want to mess with that risk. I would rather book the partial profit if I can, free up the capital, and move on to the next trade. All right. So 50 to 75% is our profit goal on both the GLD and the XLE trades. We'll continue to track these going into the next week. And as always, if you have questions on how to take the trade, how to manage the trade, should I close it out, should I hold on to it, you can always leave a comment here on the video or on the blog, or email me directly, mike@netpicks.com. More than willing to answer any questions you have or review your trades with you. Okay, so those are the 2 trades of the week here on gold and XLE. Let's talk about our open position from the trade that we talked about last week. It was a position that we looked at on Apple, and we were using the June 8th weekly options. So those are the ones that have 21 days left at this point. And let me switch this from XLE to Apple. We sold the 192.5, 195 call spread. And we collected 84 cents to put this trade on. It's now trading for 46 cents. So we are right there around our 50% profit number. This was a bearish position on Apple. We wanted it to move to the downside. It has done so, not in a big way. But remember, when I sell a spread, I don't need a big directional move. I'm just looking for either a directional move or a period of consolidation. So this trade so far has worked out nicely. We've had Apple with a small move to the downside. We've had some time decay add up, and we've seen volatility decrease. So we've had multiple different ways of making money on this trade, and so far it's starting to add up. Now I'm almost at my 50% number. So when I say we're targeting 50 to 75% of my maximum profit potential, which one is it? Is it 50 or 75 or anywhere in between? The first time I'm willing to close out of the trade is when I hit that 50% profit number. But I don't just immediately get out. That is the first time that I will reevaluate the trade. Meaning, has anything changed since I put the trade on? Has my outlook for the overall market, or has my outlook for Apple specifically, has any of my outlook changed since I put the trade on? Well, in this case, I still think Apple's overbought. We really have not had a very deep pullback at this point. We're playing from a position of strength because now we're in a partial profit. Okay, the time decay is also adding up. In this case, I would go ahead and hold on to the trade, and I would start to shift my focus to that 75% max profit number. Okay, so 42 cents, anywhere from 21 to 42 cents is the acceptable range to close out of the position. My focus is shifting now towards that 21-cent number, that 75% of max profit, because my outlook hasn't changed. Nothing has changed as far as what I think the market's going to do over the next couple of weeks. I think we're going to see some chop. I think we're going to see some pullbacks continue. So I'm going to hold on to this trade a little bit longer and go for the bigger profit. If you're uncomfortable with that, if you'd rather book the profit, I am completely okay with that. No argument out of me. You could close out of the position, book the profit. Right now, you've got about a close to a $40 profit per spread. So not a bad winning trade if you wanted to close it out now, because again, we're tying up a couple $100 of capital or less on many of these trades. So it's a really nice return, but I think we can squeeze a little bit more out of this trade. So I'm going to continue to hold here over the next week at least, but we'll reevaluate it next week. See if we can book the 75% profit number going into next week. Right. So let's take a look at CMG. This is the other trade that we had on previously from a couple weeks ago. Let me pull this trade up. We sold a call spread using the May 18th. So these are the options that are expiring today, and we sold the 435 440 call spread. Right now it's currently trading right at 435. We sold this trade initially and we collected $2. Okay, we collected $2. I want to make sure I get my strike prices right here. Yeah, we collected $2 per spread. It's now trading for $1.42. We were able to close this thing out earlier in the week for around 50 cents. First thing this week, we had CMG to the downside. It has since bounced off of those lows, but knowing that our 50 to 75% target range is always there from the moment we put the trade on, as soon as that level was hit earlier this week, I closed it out. I booked the 75% profit, closed it out for 50 cents, and booked the $1.50 profit, or $150 of profit per spread. So just a really nice trade again. We just continue the really nice stretch with these options trade of the week that we've called. I mean, we've only had one losing trade here over the past couple of months, so we just continue to see really good performance. And CMG, if you missed it, as far as closing out of the trade earlier this week, you could still close it out now, book the partial profit. What you want to be cautious of if you still have this trade on, these options expire end of the day today. Our short strike's at 435. We're basically sitting right on top of that short strike. So you need to watch this thing very closely. Anything above 435, and you really need to close this trade out. You can't hold to expiration if price action's above 435 because you're going to face assignment risk. We don't want to worry about that. So make sure you, in this case, just close the trade out. Don't worry about, stressing all afternoon whether it's going to expire worthless or not. Just close the trade out, book the partial profit, and move on to the next trade. And that's what I'll do in many cases. It's not very common that I will hold to expiration. I just rather book the profit. And that's why we did that here earlier this week. We booked a nice $1.50 profit on the trade. All right, so booked a nice profit on CMG. We've got a partial profit on Apple from last week. And then our two new positions that we're talking about here today are XLE and GLD. We'll see if we can get filled on those spreads here today. And then we'll start to track them going into next week. So as always, feel free to contact me directly. Mike at netpicks.com is the email address. I'm more than willing to walk through any questions you might have on these trades. So hopefully some of you have had a chance to grab these trades recently. We just continue to see some really nice profits. And the best part about it, These trades are free of charge, right? You're not paying us anything for these. We're just trying to give you an example of how we trade at Netpicks and also allow you to make a little money off of the calls as well. All right, so I'm going to wrap this video up here. We'll be back again next week. We'll take a look at our open positions and talk about our new trade of the week at that point. All right, enjoy your weekend, everybody. We'll talk to you next week.